So today we're going to be talking about demystifying investments. Investments are one of the things that I get asked a lot about, and joining me today is Jim Pastor, our head academic. And Jim, I'm sure you're the same way. Investments are always a question when people find out what we do for a living. They want to know what to invest in. And that's really not what investing is all about. I want to read from Investopedia. They define investment as a monetary asset purchased with the idea that the asset will provide income in the future or appreciate and be sold at a higher price. Would you agree with that definition?
Well, that's a good broad-based definition. Remember, as we talked about with comprehensive financial planning, first of all, this is part of financial planning, not financial planning in and of itself. So with saving and investing, though, that is where you're building a nest egg, you're building assets so that over time you have more flexibility and more choices that you can make down the road. Now, having said that, investing is extremely complex and there are all sorts of potential investment options. So typically the best way to approach this is start slow and easy and start with the basic investments that are out there. And from there, start to gain knowledge and perhaps, explore potentially other investments down the road.
Right, right. Now, there's a lot of investments out there, and I think a lot of people are overwhelmed by the thousands and thousands of choices of investments. But investments really fall into four primary groups, isn't that correct?
That's correct. You have four major what are called asset classes that are out there, and they are cash or cash equivalents. These are essentially assets like your short-term CDs, money market accounts, investments that the principal typically will not go down. Your principal is safe, but on the other hand, oftentimes, especially nowadays, you don't earn very much on these assets. So these are considered very safe, but the downside is it's hard to maintain buying power or getting a real sort of return. Then you have stocks, equities, also called. And with stocks, the neat thing is long-term, stocks have given us some really nice returns. If you look at the long-term returns on large company stocks, it's about 10%. Now, this is over long periods of time. Obviously, along with stocks comes volatility. And markets are up about 2 out of every 3 years, but there are down years, and there are times when the market can be quite dramatic and nerve-wracking to individuals. So you can't just invest 100% in stocks and not expect a sort of a roller coaster ride. Over time, they've done really well, but you have to be prepared for the ups and downs. So for that reason, it's probably not a good idea to have anything in any one asset class, including stocks. Then you have bonds, which are income. Bonds are buying debt. In other words, you're loaning somebody money, they're paying you interest, and then when the bond matures, they're paying you back. So you can buy individual bonds, you can buy mutual funds, but essentially you're a lender, and you're buying bonds for income. And bonds, though, can move up and down in price, though, too, based upon what interest rates do. So there is some risk there. And then finally, you're dealing with real assets or tangible assets, and typically this is represented by real estate. In real estate, there's only so much land, you own something tangible, and over time, real estate has been an asset class that has done fairly well and can generate income. So these are the four major asset classes, and typically you're going to look for some combination of all four, depending upon where you are in your life, what you're striving for, what sort of financial needs you may have at the time.
Right. So we have cash and cash equivalents, we have our stocks, we have our bonds, and we have our real estate. What is this big word that everybody talks about called derivatives?
Well, derivative, what the term means is it's a investment or a vehicle that derives its value, hence derivative, derives its value from something else. So for example, you might have an option which derives its value from an underlying stock like Netflix or IBM or whatever. So it's a more speculative and usually leveraged vehicle. For individuals, especially getting started with investing, derivatives really don't play much of a role. Derivatives can be great for especially more sophisticated and high net worth individuals. For most individuals who are starting to save for retirement, have an emergency fund, things like that, they don't need to worry about or, consider, I don't think, investing in derivatives at that point in their investment life. That could be something for down the road.
I agree that the derivatives should be something that people approach with caution and usually with some sort of guidance.
Yeah, there is no free lunch.
Right.
There's risk and return, and there's, derivatives sometimes are used to be sold to give underlying themes of like it's somehow safer or it's going to do something if this happens, but they start getting complex and expensive very quickly, And for most people, especially when they're first starting to save, as we mentioned in our other talk, fees are extremely important. And derivatives can be very expensive. So it's best to just start with your four asset classes and go from there.
Okay. So if we start with our four asset classes, what are our basic investment objectives and what are the basic concepts of investing?
Well, typically there are three major approaches people can take. They can shoot for growth, meaning they're going for the highest return possible. They can shoot for income, meaning they want income, such as in retirement, to live off of. Or they could go for preservation of principal. Let's say they have enough saved and they're more concerned about not losing rather than gaining. Now, you can do two of the three. There's no way you can do all three at once. So you have to kind of come up with a blend as far as what works best for you. Generally, the younger you are, you're going to be more towards the growth side. You have time to work in your favor. The market goes down, you should be happy, not sad. It's a time to buy more at lower prices. So from a long-term perspective, that's great, something like stocks. When you get older, when you approach retirement and are in retirement, then perhaps you want to be more focused on income, so you might buy more bonds, you might buy more dividend-paying stocks, things like that. So again, depending upon where you are is going to determine, which of the three approaches is dominant at any given time.
Well, the one thing that I've always been fascinated with is risk tolerance. It seems like people's risk tolerance is unlimited in an up market and is extremely limited in a down market. How do you find a good balance of risk tolerance?
Yeah, that's a very good question. And you're right. I mean, the longer you have up markets, the longer a market is continually going up, let's say year after year, the more people's perceived risk tolerance will go up because they discount the fact that, oh, it can go down too. I would say for most individuals, there's all sorts of risk tolerance questionnaires out there, but generally, whatever your risk tolerance is, it's probably a little less because the real gut check is when things really don't go well. We had that in 2000, 2001. We had it in 2008, 2009. We've had it at the beginning of 2016. And when markets go through these kind of gyrations where they quickly fall 8 to 10% or more, that's when the real gut check happens. So what you want to make sure with risk tolerance is you don't want to get in a position where you panic and then you sell at the worst possible time, because there are two bad things that happen there. First of all, you sell at an inopportune time, meaning you give up future potential profits. But it also means that people end up getting scared out and then they don't get back in.
Right. Which kind of comes back to something we call market timing, where people think they want to buy low and sell high. What typically happens is most people end up buying high and selling low.
Yeah, studies have shown that, people who trade by emotion consistently underperform the market, and I mean by huge percentage amounts. So it's you don't want to trade the markets. I have had people say to me over and over again, and I'm sure they will again, they'll say to me, well, Jim, the market's a little unsettled right now. Why don't we get out, and then when things settle down, we'll get back in. Well, the problem with that is the market is a leading indicator. So if you wait till things settle down, by the time you're comfortable, the only way that can happen is if the market is now much higher than where you got out. And now you're buying at a high price, and that's the exact opposite of what you want to do.
Right. And again, you mentioned earlier, time horizon is very important. The longer you have to invest, the better chances you're going to have of a solid return over a longer time horizon.
Right. If you're looking at a time period of 5 years or less, generally advisors say just don't have it in the market. You don't want to be forced to sell, at the wrong time or at a low price. And the longer your time horizon, when you get to 5 to 10 years, and then especially 10, 20, 30 years, I mean, if you're young and your retirement is 30, 40, 50 years off, it's a beautiful time to be dollar cost averaging into the market. What you can control is how much you invest. You can't control the market. But if over time you consistently invest, and that means you will be buying at times when it is very low, that's perfect, because then you'll get that upside. You don't want to have to make an emotional decision and sell at the worst possible time.
And then I guess really the final concept that people need to understand is taxes and how investments affect taxes.
Yeah, there are a couple of things that come into play there. First of all, retirement accounts, and we'll talk about retirement accounts. But the beauty there is you're deferring taxation to you actually take distributions. So you're earning money on money that would have been lost to taxes anyway. And that's where compounding, that's where you really start to see results, especially when you start going into decades. You go 20, 30, 40 years with compounding and not paying taxes, huge difference.
Well, great. Thank you for joining us today on Demystifying Investments. I think that's very helpful for our audience to understand that really investments don't need to be as complex as most people make them, as long as you understand the basics. And if you don't, when is it time to get professional help? So again, thank you for joining us today for Demystifying Investments.